Wall Street thinks this stock rally is unstoppable, but Tom Lee just issued a warning that almost nobody saw coming. We're tracking straight toward S&P 8,000. Yet beneath the surface, record margin debt and a hidden market trap are setting up a violent 10% shock. If you have money in stocks right now, you need to see what happens the moment we hit the target.
Head for stocks with targets and optimism both climbing. Let's welcome in our panel. Fundstrat's Tom Lee, Robinhood's Stephanie Guild, and Payne Capital's Courtney Garcia. Tom and Courtney are CNBC contributors. Welcome, everybody. It's good to have you, Tom. This was just what the doctor ordered, right?
It is. We got a nice CPI report, and in the backdrop of good earnings, stocks going up on good news. I think the rally is quite healthy, and it's tracking to our view that we could get to 7,900, 8,000 by the end of the month.
Well, that's what your call was, the other day. Ed Yardeni says we're now tracking so well that we can get to 8,400 by the end of the year because of the earnings story that we keep talking about. Does that make sense to you?
Yeah, I think that is sort of the underpinning of this, because 2027 earnings, probably 410 right now. It was around 395 at the start of earnings season, and it's probably going to be, by the end of this month, close to 425. And so if you put a 20 multiple on that, you're already close to 9,000.
So we keep saying that you've been bullish. You've been right. But you keep calling for this maybe 10% pullback in stocks at some point. Now, we haven't gotten it yet. And you lay out today in a note that says, quote, positive drivers for stocks in the near term remain good AI fundamental demand, right? Strengthening U.S. economy, positive revisions to earnings, and the fact that inflation remains tamer than most expect. Those don't sound like catalysts for a 10% pullback. So what is?
Well, I think pullbacks occur when we're least expecting it, and usually when investors are bullish. So I think the end of August, getting to 8,000 is going to set us up for a period where stocks could disappoint, even though underlying fundamentals are good. And part of it is the margin debt's gotten so big. Part of it is we still haven't resolved how the market views Kevin Warsh and his new framework, whether the bond market's going to have a tantrum. And the third is we have midterms coming up, and I think that's a source of uncertainty. And finally, I do think SpaceX, which had an initial unlock, there's still a lot of stock to be unlocked. So I think all of that represents potential traps ahead.
Okay. Steph, what do you think about that?
I agree that, typically like when you have a period where a hedge fund, for example, blows up, it's a sign that there can be just easy credit conditions and leverage builds up. I think that kind of cleared, but I think we're going to have another one. I just think in this environment where AI is driving things, you end up having like almost speed crashes. I've heard Jordi Visser from 22V say, and I agree with that, because I think you have parabolic moves and then kind of consolidations. I also think interest rates are certainly a risk that could keep flaring up. But I also agree that there's strong fundamentals. So I think that's going to be a fight within the market.
The resiliency of the market has been amazing in the face of what you've described, a hedge fund blowing up, yields backing up. But aren't we a little cleaner now in a number of ways, right? You get a little bit of heat off of the inflation picture, and the positioning is cleaner, and we've delevered a little bit. Tom's right. There's still a fair amount of, leverage in the system, margin debt and whatever, but feels like we've cleaned some stuff up.
But I think with a rally continues and then you start rebuilding that, and that's why I say like you could end up having another kind of pullback because the debt rebuilds.
Court, are people too bullish?
I don't think so. And I think ultimately the markets are being driven by earnings right now, and the earnings are justifying what the markets are doing. People were getting concerned about CapEx spending, but I think the more that you see these earnings come out, it really is justifying that. And I think when you look at the markets as a whole, if you look at the last 3 months, the things that are leading are healthcare, financials, industrials. Those are all actually outperforming the S&P 500, which means you're seeing this really broad-based rally. There's no longer just 7 names that are holding up the markets. And the fact that even in days where AI is driving the story, you're seeing everything participate. I really like that as a good story. And if earnings keep holding up and the consumer keeps holding up, I think the markets will continue to drive higher.
I'm glad you went there, because if you look at let's call it the balance over the last 30 days. So 1 month performance, financials, almost 4%. Technology, 3.25%. Industrials, 2.5%. Healthcare, 4 2/3. Materials, better than 3%. this is just what people were hoping for, isn't it?
Yeah, it's broad-based. I think this is a sign, and of course, as you know, global markets are doing well, and there's still several $1 trillion of cash on the sidelines. And I think that there's still a pretty level of healthy skepticism, because I think a lot of clients of ours, institutional, think either the AI trade is extended or that we're in late cycle on earnings.
It's like an earnings bubble that's about to burst at some point.
Correct. And then, of course, they think the Fed has to react to that by tightening. So I think that there's people who are sort of keeping an eye on the end of the bull market, and I think that's what's keeping it healthy.
I think I corroborate with that, because if you look at like valuations have actually come down by 2 turns, but earnings growth have more than doubled since the end of March. And so I do think there's a healthy, that to me is the numbers behind the skepticism. And I welcome skepticism, because I actually think it means that the bull market can go on for a bit longer. And so that's kind of like 1998 after LTCM, like the market went up for another 18 months and 35%.
While the path to 8,000 looks clear on strong earnings and cooling inflation, the real test begins the moment we touch that target. As Tom Lee pointed out, record margin debt and sudden shifts in sentiment mean pullbacks strike when markets are most euphoric. Are you taking profits at 8,000? Or are you holding through the potential 10% dip? Drop your strategy in the comments below. If you found value in this breakdown, smash that like button, subscribe to the channel, and hit the notification bell so you never miss our next market briefing. Thanks for watching, and we'll see you in the next one.